We have our guests also standing by patiently to talk about the markets and what exactly the move means. We have Kunal Bothra as well as Dipan Mehta joining us on the show. Very good afternoon to both of you. And I'm sure, Kunal, you're also supporting green like the way how Dipan is by wearing green shirt today. Green on the screen. Are you happy or no, Kunal?
As I said earlier, that any kind of green, light green, dark green, any kind of green is good for the markets, because after so many days of red, I think it's good to see that the markets are stable. So, but I think today's day is more of so even if the India VIX is at 18 plus levels, we have not seen the usual volatility like what we've been witnessing over the last many days of this sell-off. So large caps have been showing signs of stability. Mid caps have seen follow-through price up move in a very good recovery from their oversold territories or sharp corrective phases. So I think it's a different day altogether for the markets. We may not be able to compare this with the previous maybe last 1 or 2 weeks, but this could probably be just an indication that maybe the markets are trimming off positions on the short side. We saw the data on the FII over the last 2 days, specifically yesterday, where cumulatively over the last 2 days there has been almost like a 10% reduction in the net short positions for the FII, and more importantly there have been more long additions which have happened for the index futures contracts as well as for stock specific futures. So that indicates that the bias is now shifting from a deep negative pessimistic scenario to maybe some bit of stable scenario, at least going into the expiry as well as the budget event.
Okay, so that's the take coming in as far as the market setup is concerned, and yes, we'll take any shade of green right now. But Dipan, what's your view on the market? Which are the pockets that, let's say, you've started buying into or you're looking to buy?
Yeah, good afternoon. Thank you for having me on your show. Why do we assume that we have to always buy? The question could be, which are the pockets you're thinking of selling? See, this is the thing which is happening in the market, that everybody wants to look for buying opportunities, but clearly we have a structure in the market which has got damaged very badly. We have got major threats in terms of Trump, in terms of a sharp slowdown in the earnings. I think nobody is looking at that at all. This earnings season is amongst the worst I've seen in several quarters. At the same time, we have a GDP slowdown. We have a budget which is uncertain. Hopefully, they won't raise any taxes over there. And there is very limited leeway for the RBI to reduce interest rates given the inflationary scenario. So there are so many battles we are fighting on so many fronts. And why should we just always think about in terms of buying anything? I would say that the sectors which are still worth selling are commodity companies. Any high PE company trading at 70, 80 times, which has disappointed in the earnings, that is a sell even if after it has dropped by 20, 30% or so. And let's just keep buying away for the time being. It's not reached those levels. They will do soon. I'm sure they will at some point of time. But I think there's a lot more pain left in the market. And rallies like these are good opportunities to lighten up your position. And if investors have got margin trade funding, leverage positions in F&O, then I would say that they're on a very, very sticky wicket.
Any of these names that you want to give when you talk about the ones that you should lighten the positions on?
Well, I think investors can do their own judgment call. As I said, I think first of all commodities, cement, steel, they have disappointed big time. Those are the ones I want to, completely exit. We never had them in our portfolio, but investors still have them. And a lot of new listings which have taken place, right, in electronic manufacturing services, to an extent, solar equipment, even some of the renewable energy companies, businesses linked to electric vehicle. All of these, I think you need to review. They're great businesses, no doubt about it. Great companies also have created a lot of wealth in the past. But look, they are highly, highly overvalued. And one needs to look at opportunities to exit over there. I would add FMCG also to the list. You've seen major disappointment likes of HUL, Godrej Consumer, Imami. I mean, the list goes on and on. There's a massive structural slowdown as far as FMCG is concerned. So I think that, by and large, we need to be extremely careful of which stocks you have in your portfolio.
Right, so that's the take coming in on which are the sectors or segments that you can actually be wary of at this point in time. Kunal, what's your view then when it comes to the metal space? Are you liking the space right now? Or do you think, or you concur with the view, the time to lighten your positions over there?
So maybe selectively, I think few metal stocks are showing signs of bottoming out, and this could probably turn out to be more of a temporary bottom. But even if that happens, I think at least the sell-off in the metal stocks or few of the metal names, I think that should recede significantly. So what we've seen is, for example, Tata Steel, a stock which was one of the first ones to sell off from the entire metal pack, I think 6-8 months back, from 180 or 84, which is the high for Tata Steel, towards the point where the stock was sub 120 levels. We're seeing ample evidence that the stock has shown signs of a critical bottom formation. The indicators were deeply oversold, and now what you're seeing is a shade of a strong recovery coming back into the stock, and this has trickled to the other stocks in the metal pack, where you've seen JSW Steel, which has been a more stable or a slight moderate beta stock from the entire metal pack. Also trying to find its feet back again. The stock has recovered 4 to 5 percentage points from its previous swing lows. So when you have such kind of data points, it just indicates that maybe all is not gloomy for the entire metal pack, and you might probably expect few of the stocks to try and outperform or at least give a counter rally.
Okay, let's see whether that counter rally really happens or not. But today there was a bit of a surprise with the ITC hotel listing being a bit of a muted kind of performance versus the expectation. Given the market mood today is quite buoyant, one would have assumed that perhaps that stock is likely to see a green uptick. In fact, we did catch up with the management, Mr. Sanjeev Puri, to understand what the way forward is for ITC hotels. But before that, Dipan, your take as far as ITC hotels is concerned, and do you think there's going to be a bit of a pair trade with Indian hotels versus ITC hotels now with the new competitor?
Yeah, I think it's a good development. You have one more nice hotel company, large size, well diversified, to look at investing. And certainly hotels have it a purple patch. Next few years also look very interesting for these companies, considering that fresh capacity takes time to build up. So I think certainly we'll be looking at ITC hotel in positive light, as in valuations at reasonable levels. But look, Indian hotels, the kind of strategy they have, and the kind of momentum that it has picked up, and the kind of new openings which are expected, and the way they've been able to get higher revenue per room and increase the capacity has been phenomenal. I think I've been watching Indian hotels for the last 30, 40 years, and it seems to have entered a fabulous new growth phase. And that's reflected in the very high P multiple as well. So I would say that amongst all the listed hotel companies, our favorite still remains Indian hotels. As an investor, I would remain invested, pretty happy with the numbers and other thing, and always a bit concerned about the high valuation. But these are the stocks, maybe Indian hotels you could look at. If it's down 25-30% from these prices, then it's a reasonable valuation. You could look at making a fresh entry or adding to your positions.
Welcome back. You're watching Closing Trades right here on ET Now. We are building on the gains when you talk about the benchmark indices, 0.8% uptick coming in for the benchmarks. You have the broader markets. They are the star performers in a trade today. We also have Shrikant Chauhan joining us on the show. Good afternoon to you, Shrikant. And yes, we did speak about broader markets as well as the benchmarks a while ago. But let me take your view. What exactly is happening in the banking space? Because they've been actually pretty upbeat in trade today, outperforming the benchmark indices at one point in time. Now it's in line with benchmarks.
Yeah, good afternoon, everyone. I think, for Nifty and Bank Nifty, I think, Bank Nifty is actually supporting to the broader market, and we are seeing consistent upward activity since the last 2 days in Bank Nifty.
Shrikant,
Today it is like
bit of a patchy line. We'll try and reconnect that and get that understanding better. But Dipan, just wanted to deep dive with you on the auto sector a bit more, because it was going through a bit of a headwind. That festive season sales weren't strong enough. Now with the earnings coming in, at least on the margin front, a couple of companies have surprised. We're waiting back for Tata Motors earnings as well. But how are you looking at separating the men from the boys within the auto pack?
Yeah. Am I audible?
Yes, Dipan, you are. Go ahead. Okay, Dipan as well has seen a bit of a technical glitch. I think the telecom sector clearly needs to be in focus with respect to the kind of tech issues that we are facing on the bandwidth front. But Kunal, I don't think that can be the case with you, given the fact you're with us in the studio. Your sense as far as the EMS space is concerned, because does it give you the sign that it's bottomed out?
Yeah, it seems like, because that final phase of sell-off which had happened the last 3 days, yesterday specifically, where many of these stocks, they were down 15%, 10% on average, so double-digit, sell-off into these stocks. And look at today's price action for many of these names. I think many of these stocks are showing like a V-shaped recovery, the entire EMS space, and I think that's a very strong indication. So then the second technical feature which you look out for is that what are the volumes, what are the set of volumes which have happened on both those days. when the stock opens with a gap down, falls lower, down 10, 15, 20%, and then on the next day of recovery, if the volumes on the day of recovery are much higher than the volumes which the stocks have shown when they have fallen lower, that indicates that there's been renewed buying which has happened to these spaces. We also look at the fact that many of these stocks have come back above their respective 200 moving averages. For example, Sirma SGS, you've seen Keynes Tech, PG Electro Plus. I think many of these stocks have come back above their respective 200 moving averages after staying below this level for the last two days or so. So that again is a strong indication that a major bottom is now in place. And when you typically see such kind of V-shaped bottoms being formed, we expect that these stocks, they generally get into a much more further uptrend over the very near term at least.
Point taken. So that's the view on the EMS space, but I think we do have Dipan back with us. Dipan, you were making the point about the auto sector.
Right. I think that, the problems which are plaguing the auto sector, that being slowdown in sales and higher discounting, that has not, completely dissipated. So you could expect one or two more challenging quarters as well. And look, I think there's only so much the company can grow by improving the margins. End of the day, the top line has to kick in. And one could be a bit selective. Actually, I'm looking forward to numbers of Eicher Motors, which the volumes also have improved significantly. And it's been a laggard in the auto sector for the past several years or so. And they have been working very hard at improving exports and launching new models and trying to improve their volumes and realization. So this could be a kind of an outlier within the auto space. But other than that, I would like to be equal to slightly neutral, neutral to underweight auto. And also looking forward to M&M's numbers. I think that could also be an interesting beat over there. So these are the two companies within the auto space, which I would bet on. And as a measure of disclosure, we and our clients are invested in it. But even in these two companies, don't expect superlative returns. I think it's just that within the auto space, they may do slightly better than the rest.
Right. Dipan, I wanted your view on the entire defense pack. Where do you see this one headed going ahead? Do you think that now with this correction that has already creeped in, now we'll have the budget, we may get to hear something about the defense allocation as well. And given the fact that the government has been having the thrust on the self-reliance, Atmanirbhar Bharat in the entire sector as well. Do you think after this fair bit of correction, it's time to look at the defense space?
I think let's just give it some more price-wise, time-wise correction. I think my assessment is that you will have more of time-wise correction as far as PSU defense is concerned, and you may have an actual price-wise correction of 25-30% also as far as private sector defense companies are concerned. So whichever way I look at it, I think I just want to wait and watch as far as PSUs are coming. Especially as far as defense is concerned, especially considering that there's good order visibility. At some point of time, they'll become interesting in terms of investment because they have the earnings visibility. But it's just that you're paying far too high a valuation and P multiple at this point of time. And the numbers are coming through. So even if the prices remain the same, the P's will contract purely on account of improvement in the earnings. And you will reach a nice position, I think, a few months, maybe 1 or 2, 2, 3 quarters from now, where the P's are at very, very reasonable levels, slightly cheap also. Plus, you will have earning visibility, and that's, I think, is the right entry point. So it's a wait and watch. I'm certainly not taking the plunge even after such a massive correction. I just feel that some more price or time-wise correction is left in it.
Shrikant, what's the take on the IT pack? Has made quite a bit of reversal, and especially the beaten down names like KPIT Tech, which weren't moving with the large caps earlier, are now reacting quite sharply. Even Persistent and others post earnings have seen quite a bit of comeback. What do you like now, large cap IT or mid cap IT, and what names?
Yeah, I think if we consider these IT stocks, then in that all these mid cap IT companies, they are really doing well. Most of these stocks are forming continuation formation after correcting when the market was correcting, and now after the result, stocks like Coforge, Persistent, they are really doing well. And I'm of the view that we should look for adding these stocks to the portfolio instead of adding large cap companies, at least for the next few days, because for next few days, I am expecting market to remain volatile. But in that, if we see any specific momentum sort of activity in any particular segment, then mid-cap IT stocks should do well. In that, of course, we like Coforge, which is currently around some 8770 sort of levels. There we should look for adding long positions. I'm expecting the stock to move towards the levels of at least 9400, 9500 in next maybe few days. And here the stop loss, the risk reward ratio is quite favorable. We can keep stop loss somewhere close to 8500. We also like persistent system where the stock is trading at 60 to 50. Currently, it is up by 5.5%. But the entire formation is indicating us that the corrective pattern is completed and now the stock is heading higher. So the next level to watch out for would be somewhere close to 6,700 again. So broadly, yes, we are bullish on all these mid-cap IT companies.
Srikanth is pretty bullish on that one. On that note, thank you so much, Dipan, for joining us on the show to talk about the various sectors that you should look at or you should not look at this point in time. Thank you so much for sharing your views. But Kunal, let me come to you and get your closing trade picks for our viewers.
So L&T Finance is a very interesting chart. The stock has been confirming breakout above 140 mark, and apparently over the last 1 week the stock was less volatile as compared to its other peers. Looks attractive, and the stock confirming a breakout today on the back of higher volumes. Would look out for buying the stock with a potential target in the near term, at least around the 150 to 160 range.
Srikanth, what about you? What's your closing pick?
Yeah, I think at these levels, there are like number of stocks which are breaking out of their consolidation sort of formations. In that specifically, we like Apollo Hospitals, which is currently trading around some 6,700 sort of levels. And from here, if we see the upward activity, then the stock can move towards the levels of at least 6,700, 6,900. So currently it is at 6,780. We can keep stop loss at 6,700. And the next level to watch out for would be 6,900 to 7,000. The stock is forming higher bottom sort of formation, so it's a buy. We also like Trent, and Trent is like currently at its important support levels. It was correcting from the highs of 7,400 to almost 5,400 levels. And if we see the entire pattern, then it has been corrective sort of pattern. And now after completing the levels of completing the correction at 5,350, 5,400, the next level to watch out for would be again 6,000. At this level, it's a buy. The risk reward ratio is quite favorable with a stop loss close to 5,350.
Point taken. That's the view coming in.
If you like this video, then like, share and subscribe to ET Now.